All right, episode 6. Today, it's the fight of the century. Who would win? Single-family investing versus multi-family investing. We're going to get started right now. Episode 6. We're excited to bring this one to you today. Today's show is brought to you by our favorite sponsors, Deep Blue Capital. Just go to deepbluere.com, deepbluere.com. And sign up for our newsletter. That way, Deep Blue, they are bringing you a weekly newsletter on what's going on with current projects, potential projects, just everything all about multifamily investing. So thank you guys at Deep Blue Capital, as well as this studio is brought to you by Tor Studios, Tore, and Jesse Showalter, our producer. So if you're wanting to make a show just like this, just go to torstudios.com and connect with Jesse Showalter. And before we get into today's show, which is better, single family investing versus multifamily investing, which one should you go down? What path? You need to go listen in on the last shows. I mean, this is now our 6th one. Last week's show was really good. We're starting to see reviews coming in. So go and leave us a review on Spotify, podcast, Apple Podcast. Where else do we have them?
YouTube.
Well, that's not really that. I was going to go to that one next. Thanks for jumping in, Matt.
Sorry.
Jeez.
Dude, go on the important ones.
Up for everybody.
Apple and Spotify.
Yeah, if you're listening and consuming the podcast version, just go on that, or go to YouTube. We're really working on our YouTube channel on that. So go to More Doors Podcast on YouTube.
More Doors Podcast.
Yeah, More Doors Podcast on YouTube. That way you can watch this video version of it. So we're excited to bring you today's show, Single Family versus Multifamily. Matt and Brian coming in after the 4th of July holiday.
I know.
It was a good weekend.
It was a good weekend.
Although I will say that I think the Tuesday holiday makes it a little awkward.
Yes.
I didn't get any extra vacation time this week, which I'm a little upset about.
Yeah.
But I'll lick my wounds and
so you worked on Monday, didn't work on Tuesday, back to work on Wednesday.
Yeah.
It feels weird. I kind of felt like just mailing it in the rest of the week, but it's not. There's not enough time to not do anything. Now it's Thursday already.
I mean, I will also say that I think last weekend was awesome. Sorry for the sidecar here, but we got to see Dave Chappelle.
Yes.
I heard
in
it was
town
great.
in Dallas.
Bro.
It was amazing. And then we went to spend some quality time with Brian for his birthday party on Saturday.
Did.
Chuck E. Cheese.
It was
Yeah.
Chuck E. Cheese.
Yeah.
It was a quiet affair. It was fun.
Yeah.
It was definitely fun.
Did you rent out the whole place? Just you went total
Yeah.
private party.
Rented out the whole place. I played in the band.
I thought you were the mouse.
Oh, there we go.
Look, you haven't made it until you've rented out Chuck E. Cheese.
I know.
Yeah, as an adult party.
When was the last time you actually went to Chuck E. Cheese?
I couldn't tell you. Probably last week.
I was a fun time pizza kid. Fun time pizza was the jam.
Fun. I don't even know. It was Showbiz Pizza back then.
Oh, okay. You know Fun Time Pizza? Okay.
No.
Was
Was that the one in Toy Story, that one?
No, that's Pizza Planet.
Oh, okay.
Yeah.
Sorry.
Crazy, I knew that.
Yeah.
I don't watch that movie
All
all the time.
right. Let's get it. Let's break this down. So last week's show was really good. And you go back. Is it episode 2 where we break down the Waco deal?
That was episode 3.
Episode 3. That's right. Episode 2 we had Brian from Terrydale Capital.
Yeah. Yes.
Which side note on that one, another sidecar, Matt, is I'm in this storage coaching program, and they had someone from Terrydale Capital share about it. So it's where I sent you the pro forma.
Oh, nice.
Yeah, so Terrydale Capital's all over.
Terrydale Capital's great partner.
Love those guys.
Shameless plug for those guys.
Yeah.
Give them a call.
Friend of the show.
Yes. And so, episode 3, we break down a case study about the Waco project that we all invested in. And today we want to talk about single family versus multifamily investing. Which one should you do? Is one better than the other? I will tell you that, Matt, I don't know much more. much about your single family. I know you had a few, but a lot of the stuff I know you for is more multifamily.
Yeah.
Brian you started out in single family investing.
Mm-hmm.
I started out in single family investing and then grew that, and then ultimately felt like I had to graduate into multifamily.
Yeah.
Right.
And I think that's kind of where most people start.
Yeah, I think most people start there, and I think that's because, there is probably some truth to this, but it's more accessible.
Mm-hmm.
It's probably not vastly more, I think the ideology of how much more accessible it is than multifamily is a little overblown.
Yeah.
Like people that have never invested in multifamily or maybe never invested in real estate, it feels like doing a big multifamily deal is like so much harder and way far above and beyond doing anything single family. And I think that can be true to an extent. But once you hit a certain tipping point with your single family portfolio, it's probably easier to do multifamily deals. So I don't think that gap is quite as big as people think it is. But most people start in single family simply because it's easier to buy one house. You live in a house. You're more familiar with it. And it feels a little easier. There's that ripping of the Band-Aid moment when you buy your first investment property that you're just positive you ruined your own life. And it's always easier with just one door.
Yeah.
I think that's why people
By the
start
way,
there.
on the multifamily, maybe this is just me. Does it feel every single time that you're about to pull the trigger on a deal that it's just you go into this panic-driven anxiety
That's
attack?
definitely just you.
And it keeps you up all night long. And you're reanalyzing all the holes in it that could just sink the ship.
Yeah.
Well, yeah, it's bigger numbers, right? I mean, I think Brian said this when Brian was on the show, or the other Brian was on the show. That
You're on the
you
show
can-
every time.
Yeah. You can buy a single family and it doesn't appraise, or you lose a little bit of money because you took out a hard money loan, etc. And you can kind of lick your wounds and recover fairly quickly. And I think, look, real estate, at least where we are, has been very, very forgiving over the course of the last few years. And even if you bought something at the wrong price, if you hung in there long enough, you can typically get back above water.
Yeah.
But I think the daunting thing about multifamily, when people start to see lots of zeros and commas in the purchase price, is like, holy crap, if something goes wrong here, I'm going to be bankrupt, or I'm going to lose all my money, and et cetera. And you certainly want to be conservative and evaluate all your details. But the principles aren't that much different.
No, they're really not different at all. It's more kind of scaling your ideology to more doors.
Yeah.
More Doors podcast.
Get it?
Right?
Got it.
I mean, it's
Shameless plug number 2.
At the end of the day, right? It's revenue and expenses.
That's it.
So it's all the same. It's just kind of how you calculate those things, because you're diversifying your expenses and your revenue across more doors.
I think you add one other element in that you can kind of skirt by on single family, is that on the having more doors, having that multifamily asset, you're now operating as a true business.
Mm-hmm.
Yes.
And what we have found is that a lot of times that people aren't, they just bought this to buy it because the numbers look sexy. It's a bigger number.
Yeah.
They maybe graduated from single family, so they just think that that's the next move up.
Yeah.
But they're not understanding that this is a legitimate business, that you have to figure out how to drive down some of your expenses, and how do you operate this as a whole. It's a 24/7 business.
Yeah.
There's a famous, potentially infamous, about to be deal that we're looking at right now, that a lot of people are looking at, that's north of us. And it was the operators, they got in earlier this year. We spoke with them and they were very, very honest. They're like, this is not what we do for a living. We're actually oil and gas guys. We got into this because real estate has stable returns, and they bought 7 apartment complexes that need just full-on heavy lifts, and they're immediately like, we have no plan for this.
Right.
So you are right. It's definitely, you need a much more dialed-in business plan in the multifamily space than
Absolutely.
the single family, I think.
But I think, just kind of go back a few minutes, this is an assumption. We haven't talked about this, but Brian, you and Nick, you're both in the single family business, right? So it's probably in the course of doing business where you would see a property come up and you're like, wow, that's undervalued. I can go grab it. I can flip it. I can add it to my portfolio, etc. But for someone like me that's not in the business per se, like building single families was tough.
Yeah.
It takes You buy it, takes a couple of months to stabilize it, depending on how much work you need to do, finding the right tenant, etc., and then you can move on to the next one.
Yep.
And with a full-time W-2 and kids and sports and
100%.
all kinds of stuff, it got to be a lot. And at one point, my other partner Mike and I, we looked at each other and like, how are we going to scale? Because neither one of us is in a position to exit the W-2 yet, right? And we're like, I was going to Richardson on my lunch hour to like unclog toilets for a while. So the whole self-managing thing is a whole nother podcast.
Right.
But it just got to the point where it was so time consuming to do one at a time. And we're like, if we're gonna build up a business and try and get off the golden handcuffs, we got to do bigger and we got to do more and we got to do it as quickly and conservatively as possible.
So I think that is maybe the biggest way you could hit the nail on the head as far as like the pros for multifamily investing is on the single family side. You could organically put yourself in the way of good deals by being in the business, right? But 99% of people, they do something else for a living, and then real estate, is the way they're trying to build legacy wealth and retire. And if you're not putting yourself organically in the path of those deals, you have to have some sort of lead generation strategy, and it can be difficult. And then as you scale, the thing with single family is you have to do quite a few deals to really hit your financial goals. If you're making a couple $100 a month in cash flow on a rental, that's good. That's really good.
Yeah.
But then you figure out what you've got to do portfolio wise, to really build that cash flow up over time. And then you're also looking at the competitiveness of the single family space. Every single good deal in the single family space, especially in this area, we've seen it, is going to get bought.
Well, if you want
immediately, right?
Let's just break down the numbers. You're making $300 a month free cash flow, so
Sure.
net cash flow, and you want to make $30,000 a month.
It's 100.
Right? You need 100 single family properties. And so if you look at, all right, you're working a full-time W-2 job, what's the goal? To acquire 1 or 2 a year? Now that's going to take you 50 years.
Yeah.
Right? It takes you, if you get 10 a year, that's 10 years to get to that 100 to make $30,000 a month.
Yeah. Getting 10 a year when you're competing against other good investors is very difficult.
Yeah,
Exactly.
because you probably don't have the lead gen mechanism set up. It's going to cost you $5,000 to $6,000 a month in just mailers if you're going direct to consumer.
Yeah, your cost of acquisition. We didn't even talk about that.
Well, cost of acquisition would still be high-ish, but you got to make sure that you're uploading the right constant new data.
Yep.
You got to send mailers out. You got to have a lead generation mechanism to bring everything into your funnel, and then at the bottom of it, it's got to spit out opportunities. But those opportunities have to be analyzed by whom? You.
Right.
And Matt, like you said, you work a full-time job. You got kids. You're in sports, everything else. So now you're having to analyze the deal. Now you're having to build rapport with that single-family homeowner. Then you're having to either go run the appointment or just make a blind offer. And they're probably shopping those offers against other investors.
Exactly.
And so to go get 10 a year,
It's a lot.
you're going to have to probably make couple hundred,
An offer
75
a day.
to 100 offers.
Yeah.
Yeah, absolutely. And then on top of that, the thing, the competitive nature of it is a drawback as well, for the mere fact that you don't really get as much forward momentum in the single family space, meaning that you're buying $300,000 rentals. Just about every investor can afford one $300,000 rental.
Right.
So your offer is no better than anybody else's. If you got a pre-qual, if you got the proof of funds, everybody's offer is basically the same. Whereas in the multifamily space, your ability to close supersedes a lot of other variables. You don't even need to necessarily be the best offer, or the highest offer, I should say. Your credibility as a team that can close and will close means a lot more in the multifamily space. So the competitive nature, the more deals you do, the more deals you can do. In the single family space, that doesn't really exist, right? Like, as long as you've got some ability to close, you're just as competitive as everybody else. So it's very hard to get deals done more easily. In the multifamily space, you're going to have brokers coming to you hand over fist the more deals that you're able to actually get to the closing table, so you build that forward momentum.
And that's already happening with Deep Blue.
Yeah.
Right? Deep Blue comes together and closes their first project together, and then the brokers start reaching out.
Yeah, exactly.
And to be able to scale. Let's call it, what would that number be? 30,000 is always a number that we keep here. Brian and I hear that a lot. 30,000 a month. 30,000 a month.
Everybody wants to make 30,000 a month. It used to be 100 grand a year. Now everybody wants to make 30,000.
Yeah.
Thanks a lot, inflation.
Yeah, so 30,000 a month. Let's just call it. We'll use that number. It's like, again, you need to have at $300 a month net cash flow on single family. You need to have 100 properties.
Yeah.
And there's two factors that play into on the single family side that can screw up your scaling, which is lending, right? Because you can't go and you can't have 100 traditional loans.
Right.
There's a cap on it. I think it's 10 to 15.
It's
I think
10.
it's 10.
It's 10 now, right?
Yeah.
10, right? Now you can go and get portfolio loans. So you can go get 10. You can go, if you, let's say you could find 10 a year over the next 10 years. So you buy those 10, you can actually then refinance them into a portfolio loan, and then you can free up your other 10. But that's a lot of work.
Yeah.
Right? That's a lot of work, a lot of moving around. And it's also, those 10 is going to probably cost you how much in down payment money?
If you're buying $300,000 homes, I mean, $75,000 down each, right? So you need $750,000 for down payments a year.
$750,000 a year,
right?
Most people don't have that.
Right.
That's doing that, right? So the liquidity then becomes a problem.
Agreed.
And then the other factor is, let's say that you were able to find that, and it's $300. We'll use the $300 net free cash flow a month that you're getting. Is that one water heater goes out?
Mm-hmm.
One heating and air conditioning system, it's 100. It's been 100, 101 lately here. Your air conditioning system blows up. That's
$5,000.
That's $5,800.
Homework Property Management can tell you how rampant that's been the last few weeks. We've had like 10 ACs go out.
$5,800. So $5,800 wipes out pretty much your entire cash flow
for 2 years.
Yeah.
Yeah.
Right.
Yep.
For 2 years. By the way, I'm also gonna put this out there. I think it's very difficult to be making $300 a month net on rentals right now, right? With insurance going up the way it has, and if you're borrowing money, even if you still qualify for Fannie or Freddie debt, right? It's what, 7% right now?
Yeah, it's
a little bit higher,
a little more.
A little higher than 7.
I mean, properties aren't getting any cheaper, at least here in Dallas, right? We haven't seen any sort of massive adjustment, but everything else has become more expensive. Right, and your profit margins get squished.
So this is what I'm glad you brought that up, which was not in our notes. So I do want to say, like, as we're going through and making sure that wasn't in our notes, and I'm glad you brought that up because I'm seeing
going off script.
I thought I was going to get yelled at for going off script.
No,
sorry.
Because that is this should be the key point of today's show, because most individuals and most people that want to either become an investor, they're doing it to do a couple things. Right? Either they're wanting to quit their W-2 job and they're wanting to have some more time freedom, or they're also looking at it from a retirement capability over the next several years, 10 years, whatever that is. And on the single family side, I have a lot of clients that have reached out. They say they want to go buy rentals. We go analyze. They send me the deals because on the MLS, what do real estate agents do? They'll put in amazing opportunity for investors, great rental opportunity for investors. Then you go analyze it, and you just go get any rental analyze calculator for free.
Yeah.
You plug in property insurance, you plug in property taxes, you plug in some maintenance, 5% vacancy, and then you start playing around with the rental numbers versus purchase price and everything else. And over a 20-year hold, your cash on cash looks amazing.
Yeah.
Mm-hmm.
Even at a 3 to 5% appreciation rate, your cash on cash when you go to sell that in 10 to 15, 20 years looks great.
Yeah.
But your negative cash flow forever.
Yeah. Right.
Forever.
Yeah.
And these investors, we send it back, we'll do a recording on it. They're like, your taxes seem too high. The insurance is too high. I'm like, no, guys, this is where it is in Texas.
Yeah.
And so that 1-to-1 ratio gets screwed up on that 7% or 7.5% interest rate.
Totally.
So now you're having to buy it at a 1.5 to 2 times ratio.
Yep.
Mm-hmm. Mm-hmm.
Yep.
So if you buy something at $300,000, you really need it to be renting for $4,500 a month and upwards in order for it to cash flow.
Yeah, and I think you just brought up something really important, Nick. Is I talk to a lot of people that are trying to get their feet wet investing, and they're looking for some guidance and stuff, and they want to start out with single families, or they think they do, right? And they're like, well, I can get $2,000 for this rental, and according to the mortgage calculator, my mortgage is going to be $1,650, so I'm going to make $350 a month. Looks like a great deal, right? And I'm like, stop right there, slow down, right? Because you need to budget for vacancy and capex and utilities and all that sort of stuff. Because if you don't, to Nick's point, you're going to be in a negative spot forever.
Yeah.
And that's not
Great
a place
tax
you wanna
write-off,
be.
though.
Yeah, you know what? But you got to tax write-offs are only good if you're making more money.
Correct.
Right?
Yeah.
They only let you write off so much.
Yes.
You know?
Yes. So, so that's where I've started, as a real estate broker, that this is where I've struggled for a long time. I was like, all right, how do I help them? Single families probably not the best move for them. And it was like, well, we didn't have that next move to get them into multifamily because they didn't want to operate it themselves. So I'm not selling them an apartment or anything like that.
Yeah.
And it was like, okay, that's where that next round of we'll call it deep blue capital comes into play. And it's like, guys, I'm going to start referring my clients to there and saying, this is something that from investing you probably haven't looked at.
Yeah.
Where you go take that down payment money and you buy shares into a syndication project, and now you're able to participate in something that's 150 doors, 200 doors, and you're getting tax benefits. You're getting cash dividends if there's that opportunity out there. You're getting and when they exit in 3 to 5 years, you're getting your share of that profit, and then you can then keep stacking it.
Yeah.
And other than your money's out there, you're not having to go do any management. You're not having to worry about it at night. Make sure that it's in good hands of whoever you invest it with. But that is probably the next best move, especially for someone who's in a W-2 job.
Yeah.
And who doesn't have the wherewithal or the mechanism to go lead generate to go pick up single family properties. Yep. Or they don't have a good real estate broker connection that is truly presenting them good investment opportunities.
Yep.
And I'll give you an example. I just had someone on the way here out of the show call me and was like, hey, I was calling about one of your listings. I was like, all right, which one? And he's like, I represent a whole bunch of investors. This would be a great one. I said, look, bro, I'm going to tell you right now, if I list it, it's on the MLS, it's not a good deal for you, because he was looking to wholesale it to his investors.
Oh, okay.
And I was like, if I list it and put it on the MLS from our real estate residential company side, I said, that means I probably passed on it or one of my investors passed on it.
Yeah.
And so if it's out there for you, then it's not good for your people.
Yep.
And so that's something to think about is if you're going to go down that single family investment path, you have to get with a broker, or you got to go direct to consumer.
Yeah.
And that's a lot of work.
It's a lot of work. Yeah, I think the other thing that's really important that I just want to put out there is, number one, none of us here are trying to talk anybody out of investing in single family, right? If you
We're
have
all in single family,
right? Exactly. if I know plenty of people aside from yourselves that have vast portfolios of single family rentals, they do very, very well. My portfolio cash flows extremely well, right? I mean, it's a good cornerstone of the portfolio. There are some people that are going to listen to this that are like, I just want to buy one rental a year for the next 10 or 20 years and leave them for my kids and grandkids, and I'm going to be happy. And you know what? God bless you. Go do that.
Perfect.
Go do that. I think what we're talking about here is kind of the fastest route to hockey stick growth, right? In growing a very sizable portfolio. So if you're listening to this and you're like, these guys are talking me out of single family, we're really not. It's a comparison. If you want to, take things at your own pace and go buy one a quarter or one a year, by all means, go for it. There's plenty of meat out there. Go eat some and come back to us and let us know your success stories.
It's a control factor also.
Yeah.
Right? So like there's a lot more people, like they hear horror stories about investing and stuff that then it's outside their control. I'm like, I just need to control it. I need to control it. And I said, look, I get it. Yeah. But again, is it hindering your family's wealth growth? Is it hindering your retirement growth? Is it hindering, the fact that you could get to time freedom a lot faster?
Exactly.
And I've got a friend who owns 120 something rentals. He nets $1 million a year.
Nice.
From it.
Nice.
Right? That's how he built it. I know people right now with interest rates over 7%. that they've now gone to and down the owner finance path, and they're just going to people say, I'll pick this up, that are delinquent or maybe struggling financially, and they're taking over the note with little money to no money out of pocket, and just absorbing their low interest rate, and then renting it out and squeezing the difference. Yeah. And so there's definitely a lot of opportunities. What did they say? There's multiple ways to skin a cat.
Exactly.
Yeah. And so you need to become an expert in it if you go down those paths.
Mm-hmm. And transitioning, you said something before, Nick. I think there's a big difference in the mindset between an investor who buys a single-family property versus a multifamily property. You buy a single-family property, you're doing just that, right? You buy a multifamily property, you're actually buying a business,
Yes.
right? And you're hiring someone to take care of it for you, and you're outsourcing a lot of the kind of day-to-day stuff. You're holding people accountable. You're working on the business as opposed to in the business, right? Now, there's nuances to that, vertical integration, in-house property management, all that sort of stuff, kind of edge cases. But, I think and this is what really was appealing to me about making the move into multifamily is I love business. The sport of business, right, is like runs through my veins. And when I think about growing revenue, minimizing expenses, competition, marketing, right, operations, the whole thing, that's what really gets me excited. And multifamily is just like a perfect vehicle to execute that day to day.
Yeah, I think that's a really good point. If you're not, especially from the operator side, now multifamily investing, if you invest with the right sponsors and the right deals, I mean, it's a fantastic way to build wealth. Becoming an operator, right, you really do have to have a passion for the process. Like it is incredibly challenging. We talk about this all the time. The reason I love multifamily is because it's very intellectually challenging, right? Sitting there and analyzing deals and trying to find those little opportunities and being able to say no because you're not getting emotionally attached to things like that. The process of building the business and executing the plan is, I think, what's very engaging to all of us. It's where we come from entrepreneurial spaces, and so that's a huge part of it. Single family can be entrepreneurial as well, but that's really what I think makes you thrive, is having that passion for the execution on the multifamily side.
Yep, exactly. So what's the similarities between doing a single family and a multifamily deal? Like, are there any?
Well, yeah, to me, I look at it's all the same.
Like that meatball?
I know, thanks.
Sometimes it's good to have some dead air.
I know.
Yeah.
We don't do that very much.
No.
You want to practice?
I mean, we could keep it going. Then everyone would be like, "Wait, is it skipping? Is it pausing on my phone? Is it
play the quiet game?
Buffering?" I mean, to me, the similarity it's all the same business, right? Again, the show More Doors. You're just one door, two door, three doors. It's all the same. Is you're in the tenant relation business.
Yeah.
And we've got to to me, it's like if you have one single family property, or you own a 150 unit apartment complex, your job and the job of the management company on that is to place great quality tenants into that door. And you want to minimize turns. So, because every turn they're like, oh, we just get new tenants. Right. You've got to start calculating what is the cost to go get a new tenant, what's the cost for make-readies, and what's the cost of it sitting vacant.
Yeah.
Right there, you've got three kind of domino effects. Yeah. It doesn't change whether you have one door or 150 doors.
Yeah,
it's all the same. You're just now multiplying that on a much larger level.
Exactly.
Right? Yeah, I mean, the way I like to think about it is there's with multifamily, there's certainly more upside, and then there's more variables, right? So the upside, right? Everything from rental growth. When I have 100 doors and I get a $50 increase in rent, I get I get a lot more rent. I get $5,000 a month more in rent rather than just $50 more in rent. So there's much more upside. Now there's also more upside in the revenue streams that you can create. I can generate revenue in essentially one way with single family. That is my rent.
Yep.
The only lever to pull is I got to charge more for rent, which means I got to hope that the area appreciates or rents go up, or I got to make my property nicer to justify higher rents. With multifamily, you can get very creative with your revenue streams, whether that is parking, whether that is, resident benefit packages, whether that is, other income through things like laundry, amenities, stuff like that. There's a lot of ways you can make the property and the business operate more efficiently or drive revenue. And so there's more opportunity there. You're just like you said before, you're dealing with larger numbers. And so you have to be able to calculate the causes and effects of your entire business plan, right? If things don't go according to plan, how do you stress test your deals? It's really not any necessarily different. It's just bigger than single family.
Exactly.
So you got to have your numbers really dialed in. If things go sideways in a single family deal, you either sell the property, or you do whatever. But you handle it.
You can liquidate pretty fast.
You can liquidate pretty fast.
You know what I like, and this always comes back. What you just said about owning multiple doors or something like that. If you increase it by $25 or $50 a month, that now brings you to $2,500 to $5,000 more a month, $60,000 a year, and it always comes. That thought process has always stuck in my mind, where Warren Buffett, who owns Coca-Cola shares, has always said why he'll never sell it is he's like, if Coke needs to produce more profit, because they back then, and when this article came out, it's like they're producing nearly 2 billion drink servings per day.
Whoa. Wow.
Right? So he's like, why do I don't want to sell it? He's like, if Coke needs to produce more profit, all they need to do is raise their drink prices by just 1 cent per serving, and it'll produce an extra $20 million
a day.
per day. A day.
Wow.
And so think about that on whether you're in storage or you're in multifamily, where you like you said, even if you increased it by $10, right? We've been talking about and kicking around some ideas, or just not ideas, but strategies for Waco project. Is like, if you were to increase the RUBS by $5 a month, you're not gonna have people run away from that.
Nope.
Right.
And that helps cover a lot more of the expenses, which increases your bottom line revenue.
100%.
Yeah.
I mean, there's a lot of ways that you start figuring out, all right, if we do this, it's not going to push the good quality tenants away, and it's going to increase our revenue, decrease expenses a little bit, or cover that expense cost, so that it increases the net revenue for the project and the investors.
Right.
100%. So there's a lot. I mean, like I said, there's I think a lot more upside in multifamily. It is a little bit just bigger, so you have to be really dialed in with your numbers. Other parts are very similar. Mortgage, financing, things like that. They're going to underwrite the deal. Does the deal make sense? In fact, financing on the multifamily side over time can get a lot easier than the single family side.
Yes,
when you start talking about non-recourse debt, and they're analyzing the business.
That's right.
Not just when you're analyzing a single family, you're analyzing the price through an appraisal, right, and the borrower. And everything is recourse, and you got to get reapproved every single time. On the multifamily side, there's a lot more creative strategies, and they're analyzing the asset itself as much or even more than the borrower.
Agreed.
Insurance, relatively similar. You're going to have other things that you need to account for. That are a little bit different than your single family, but it's not necessarily a whole lot different.
Not a whole lot different.
And so there are a lot of very big similarities in those aspects.
I think probably one of the things that we've been on the front lines with over the last few months is, at least here in Texas and really across the Sun Belt, we've just been pummeled with storms, very destructive storms over the last couple of years, everywhere from Oklahoma to Florida, right, Texas, etc. Insurance has just gone through the roof. Yeah. And I would think that if there's one thing that's probably a little bit more difficult in multifamily right now than it is in residential, aside from finding deals, is finding cost-effective insurance. Yeah. Right? Yeah. The other thing that Nick was saying before, and what a lot of people I think need to really think about and absorb with respect to multifamily compared to single family, is multifamily has what I'll call a multiplier effect, right? I had Robert Martinez from Rockstar Capital in Houston talk to my team a couple of years ago, and he did a fantastic job highlighting one really important point. When you're in multifamily, the money is made on the renewal, right? People celebrate when they get a tenant in and they sign the lease and they move in. But guess what? You've invested a ton of money into getting that unit ready and doing the marketing and paying your property manager and all that sort of stuff just to get the tenant in. And people celebrate then. Yep. The real celebration needs to come when that tenant signs the renewal for multiple years at a time.
Yes.
So if you think about it, right, not only if you create a bad experience or let a bad experience happen, your tenant moves out. Now you're spending a few $1,000 on a make ready, and you have a month worth of vacancy by the time you turn that unit, remarket it, find a new tenant, they move in, etc.
Yeah.
So let's just say that 1 month costs you $5,000.
Yeah.
Right? You're like, well, cost of doing business, right? Now you take that $5,000 loss and think about it in if you're in a 5 cap market, that $5,000 just took $100,000 off your balance sheet, right?
Yeah. I mean, truly, yeah.
Holy crap.
Yeah.
Right? Now, if you can get that tenant to stay and get more of your tenants to stay, that adds up over time.
Yep.
And when it comes time to exit that property, your property's worth more just because you did the right thing by the tenants. They stayed, they paid their rent, they're good tenants,
Yep.
and they have good loyalty to your property.
This is why we have Matt on the show.
No, 100%.
And as a partner in Deep Blue. DeepBlueRE.com. Because, again, not a lot of people think about that. And not a lot of people talk about that.
Yeah.
Right?
That is true. We
And-
just talk about the sexiness of multifamily and going big and stuff, but like the little nuances add up over time, man.
Yeah.
It's, it can be a death by 1,000 paper cuts.
Absolutely.
It can.
That's not what sinks a project, right? It usually, even if it was bought correctly, if it's operated poorly, it's not one thing that caused the demise of it. It was, not thinking about that or putting just any tenant in there.
Yep.
Right, and we've seen that where the vetting process was not very strong, as they're like, as long as they can pay the deposit, and then they go and
like,
they
"I'm
go
on
and
rent
pay
for 12
they pay
months."
the first month's rent and the deposit. Then for the next 3 months they don't pay, and they destroy the shit out of that property.
Mm-hmm.
And now you got eviction costs. Your make ready now costs $30,000.
Yeah.
And you've lost net revenue on that for the next 5 years.
Yep.
Yeah.
Yep.
It happens, man. It's a lot like there's the Malcolm Gladwell book. I can't remember. It's Outliers or Tipping Point. They talk about plane crashes, right? Like how plane crashes happen.
Probably Outliers.
Maybe, yeah. But it's never like one. It's very rarely a catastrophic failure, right? Because usually Sully will land into the ocean or something. When that happens, they figure it out. It's death by 1,000 cuts, like you said. It's like one violation of policies and procedures gets overlooked by one person, which causes another thing that another person doesn't see, and then 3 minutes later you land 300 feet short of the runway.
That was definitely Outliers. I remember that.
Yeah, you know what I'm talking about? So, it's the same thing in multifamily. If you start to deviate from your plan too much, or if you just don't have quality oversight or great management, which is so important, putting your team together in the multifamily space, that's how deals start to get away from you. Mm-hmm. But you can course correct if you are involved so much more effectively in multifamily. If you buy a property wrong on the single family side, you really have no choice. It's just to liquidate or wait.
Yeah.
Those are your two levers.
Mm-hmm.
Mm-hmm. Foot the bill yourself or just sell it.
Yep.
So there's pros and cons.
Definitely.
Yeah.
Definitely.
What about taxes, boys? It's on our sheet. Taxes are a big one,
Taxes,
especially right now. I know. I just like my Nick's favorite 5-letter word is taxes.
I mean,
now.
I think our tax consultant hates me at this point. Like I'm literally sending him emails every day. Give me a tax projection on X, Y, and Z.
Yeah,
it's just so all over the place.
Yeah,
and look, I mean, Texas has just gotten super aggressive here over the last couple of years. I mean, look at our Waco deal, right? They assessed it for $2 million more than we paid for it.
So we're fighting that, obviously.
We're definitely fighting that.
I mean, here I'll give you some of mine right now because this is always painful. So I had one that went from 5.8 to 9.1 proposal. My guy got it down to 7. So it's still, what is that? It's still
40%.
1.2 increase.
Yeah.
$1.2 million increase. Had another one that went from 5.8 to 8.5 proposal, and they got that down to 7. So, only another
Still 1.2.
Yeah, 1.2. Then I had one went from 12 to 21, and then we settled at 15. So
that's good.
So that's a good one. And then I had one that went from 3 to 15.5. And right now,
500%
right now the
increase.
proposed settlement is 11.5, which I am fighting that one
What are we-
hardcore.
Yeah.
By the way, Nick's buying lunch. I'm just saying.
Yeah,
No.
dang.
Next time, show up with Starbucks. Nick.
Yeah. But those, I mean, those are, people don't factor that in. And for when you're selling them, they're not always great either, because you still have to have your numbers work against the rents.
Exactly.
And so proposed
Yeah.
tax value doesn't mean that's what it actually is worth.
Agreed.
And that's the biggest thing that I've been fighting the counties with. I said, if this is what these are truly worth and what you're proposing, please make me I'll give you a little bit of discount. You guys buy this and own this and operate it, please. And so taxes is one of those paper cuts that you have to underwrite in your model.
Yeah, I think the difference is up until recently, right? When you buy a single family property and they record that with the county, purchase price times mills rate, there's your taxes.
You're done.
Right?
Yeah.
And I think in the again, at least in Texas, up until very recently, it was almost like a county by county assessment, right? Tarrant County was usually pretty aggressive at 90 or 95% of the tax rate. 90 to 95% of the purchase price. Collin County was a little less aggressive. Dallas County was even less aggressive than that. Then you get to Austin, and for the last several years, Austin's been close to or at 100%. And this year, they're like, "Get ready, boys!
Yeah.
We're coming!" And they
See
just,
an opportunity.
yeah.
I just wonder if that's also because the looming recession.
The looming recession.
I think that they've just printed so much money and given away so many tax advantages over the last couple of years that they're trying to recoup everything.
Yeah.
But hey, we're getting a new stretch of I-45, so
Awesome.
you're
Hey,
welcome.
that'll be fun.
Yeah.
Thank you.
I mean, but it just take into consideration, right? Like that is one of the variables you have to really account for on the multifamily side because valuations are different. Single
Exactly.
family is literally just comps. Your neighbor has the exact same house across the street and he sold last month. That's basically what your house is worth. That's how single families are appraised, right? Multifamily is NOI divided by cap rate. So your taxes don't take that into account. So you have to be prepared to make a good case as to why your tax value should be where it is. because
Exactly.
This is a business, not just an asset.
Yeah, and look, just for those listening, right? We right now are underwriting at 100% of purchase price until we find out otherwise.
Yeah.
Right. If we can get one of our tax consultants to say we believe it's going to be X and we have justification to get there, then we'll throttle back on the underwriting. But by default, like we're going 100% of purchase price on our V1, 2, and 3 of
I
underwriting.
do feel the good news is that over the next 3 years is that we can start tracking that down, trending that down.
Yeah.
Right.
Yeah. I hope.
It should. I mean,
I can only imagine if it continues to go up at this rate, you're going to have some sort of even bigger economic catastrophe
Yes.
because no one's going to be able to afford their own assets anymore. And when that happens, you're going to start to see people just letting them go like we did in the Great Recession. And either a couple things are going to happen. People are going to let their property maintenance go to shit because that's another way to cut costs.
Yep.
They're either going to have to increase rents astronomically, way more than people can afford, and then at that point people are just going to start serving them back to the bank, and the bank is eventually going to be like, we don't want to keep taking foreclosed assets. It would cause a much bigger problem. I wouldn't even know how you would even come close to unwinding this, so it has to stop at some point.
we'll have a little bit of a reset. There's a mini reset coming. I don't think it's going to be terrible.
No, I don't think so.
I mean, we've talked about all the financial loans that are starting to reset and come due off of their locks. I still don't think it's going to be super, super insane. I mean, you're hearing some of the extreme cases in the news, but for every extreme case, that means that all that middle ground got worked out.
Nobody ever hears when a plane lands safely.
Yeah.
Ooh,
that's
you like that
funny.
one,
That's
right?
a really
Yeah.
good one, right? Improv analogy.
I like that. I
love
like that. Look, if you're looking to see what syndication projects are all about, you should definitely check out deepbluere.com. So Deep Blue Capital, sign up for their newsletter. You're gonna see the case studies of projects that they've done, that they're underwriting, and it's a good place to look at maybe placing your money, and have your money go to work because you're a hardworking person. And you, after hearing this, you now see is like, oh, it's going to be really hard to go scale single family. And so if you're looking to just put your money to work while you're still working your W-2, you're still getting to enjoy your family time, your vacation time, going all your kids' events, just go to deepbluere.com. Reach out to one of the partners, and they'd be happy to do a little consultation with you. So what's next on our list of this is that between the fight between single family and multifamily.
I mean, that's the thing. I actually don't think it's a fight, right? I think there's. You like how I diffused that?
This is the New Yorker who's.
I know. I
thought
he was always up for a fight.
Everything has to be a fight. Come on.
Yeah.
It's a tug of war, maybe.
You know what? Texas has made you too soft.
No, don't start.
Yeah.
Don't start. I think there's no one right answer, right? You have to look at your investment goals, your income, your time, what you really want to do, how hands-on you want to be in the business. Do you want to just get mailbox money, or do you want to go out and start building yourself a business? No matter whether it's single family or multifamily, the best advice I could give is just go do it, right? Do one. Every time I've bought a deal, whether it's single family or multifamily, I've always bought another one in 90 days after the first one, right? Every single time. Yep. When you start working towards your goal, you're putting that stuff out there in the universe, right? Law of attraction type stuff. You're starting to talk to brokers. You're putting offers out, etc. And inevitably, somebody always calls you back saying, are you still interested in that deal? Yep. And now instead of one, you got two. Just go do it. Learn the ropes. Learn the lingo. Build your network. Build your support structure, etc. And you'll figure it out.
Dive in.
Yeah, look, it's like when I started this of the panic attack and everything else. It's once it's in it, then it's having the knowing that our actions can also impact the outcome, right? So it's like even the Waco one. I mean, when we invested in that one, I was ready to pull the trigger the day of signing and say, like, let's eject from this deal. And as we're going through it, even that first month after, I was like, just wasn't sleeping well because I'm like, oh, I'm going out of business. And it's just not even rational thoughts.
Yeah.
And then as we see, it's like, all right, we have our we've got the weekly meetings and pretty much daily interaction with the management company, and leading to you got to get to stabilization, and that's probably the biggest part that causes the most. Chaos is getting to stabilization.
You got to get through phase one.
Yes. And you got to turn bad debt. That's always the hardest thing because you're going through evictions. You just have that excitement of closing. Yeah. And now you're like, oh, shit.
Which, when you keep it in perspective, is like normally what made it a deal.
Yes.
Exactly.
Yes.
Like that's where your opportunity was.
But you get that, you take the photos at closing. You're like, all right, guys, let's get to work.
We're rich.
Yes. In 5 years, when we exit from this, everyone's absolutely happy. And then I'm like, oh, the next day the job starts.
Yes.
Yeah.
Right? We always forget about that, right? It's the emotional cycle of change where the emotional part is you're already picturing, you're looking out through the Grand Canyon and you're not looking at the drop. You're looking at the other side like, oh, I can get to that real easy. Yeah. But you have to go through the drop and to get to that other side. And that's getting rid of the bad debt. Yeah. Evicting people. That's having to do getting the lease ups, and the lease ups may not happen as quickly as you'd like because you're also having to get through all the stigma maybe that property may have had.
Yeah.
And so then you start to work through it and you're like, all right, and we've sent these texts back and forth. It's like, I feel like we're on this emotional roller coaster right now.
Yep.
And that when we look back, you're like, remember how fun that was?
Yeah.
Even though because you forget about the bad part. Because you know that your actions, because you don't stick your head in the sands, the actions lead to the results.
Yep.
100%.
Yep.
100%, boys. Well, I'm happy to be on this ride with you guys. Let's see where it takes.
It's been quite a ride already.
Let's do some more.
Can we send a couple of LOIs out today?
Let's please.
Yeah.
Yes.
Let's do that.
Let's do it. So go to deepbluere.com. Thank you to our sponsors of the show. So Deep Blue Capital and Tor Studios. Tor, T-O-R-E, studios.com. Jesse Showalter is our producer who brings you this show every single week. And maybe there will be a live show coming to you. Maybe. If not, just go leave us some reviews, man. Go subscribe to the podcast or to the YouTube
Smash
channel.
that subscribe button.
Boom.
That's what
Smash
the YouTube videos my kids watch. Everybody's always saying, smash the subscribe button.
Subscribe. I like that.
So
Yeah,
now,
smash that subscribe button on the More Doors. So More Doors podcast on YouTube. You can find us on podcast, Spotify, and anywhere you can consume your audio podcast. So
LinkedIn and Facebook too.
Yes.
Don't forget.
Yeah.
Go follow us.
yeah.
We got
Is
big things
Facebook
coming.
working?
It's working.
It's working.
Finally?
Yes.
Yeah.
We figured it out.
God, Facebook. Come on, Zuckerberg.
Seriously.
He's
I
too
love
busy training to
Look,
fight
I have
Elon.
so much faith in Zuckerberg to be able to beat Elon in a wrestling match or whatever they're
I just
going to
really
do.
want to see it, man. What is the world coming to? What happened? Was it Conor McGregor and Mayweather, or was it Jake Paul? What was the inflection point of like every famous person has to fight now? They just have to.
I think it's great.
I think it's
great.
fantastic.
Yeah.
I'm not complaining about it.
When did we
at
get to that
all.
point?
I think it'd be better than elections.
I don't know if I want to fight
You
you.
have a 6-week
No?
fight camp, and then the first Tuesday in November, you fight the other candidate.
How many
Don't we
subscribers?
want a strong leader?
How many subscribers do we have to get on your or whatever channel? Is it YouTube? What would be our metric? Is it
YouTube
on-
would be good.
Let's do YouTube. How many subscribers do we need to get on there, Matt,
To do what?
for you to fight somebody in the multifamily space?
I don't want to fight. Wow. I'm like I got the bad rap as the New Yorker.
No, I
Yeah.
love it.
I come in
I mean, I'll
peace.
do it.
I
That's
come in
fine.
peace.
I'll do it. I'm not volunteering Brian because he used to train a lot.
I think that would be hysterical. We'd have to get a good. You're a heavyweight though. We'd
Yeah.
have to find a big dude.
Yeah, yeah. Let's see who it is.
Just don't require the mandatory drug test.
No.
No, no. I don't think they do that on any of the
Yeah.
any of the amateur ones.
Oh my gosh.
So we need to set that up. I think that needs to be fun.
Yeah.
Like some of the other syndicators.
Actually, I was just watching the documentary about the American gladiators. Can we do the
Yes.
joust with those paddle things? That would be fun.
is
That's
super
great.
We'll set it up in my pool.
That would be great.
That would be
Yeah.
that I could be convinced.
I just
to
finished
do.
the
I'd
second
like
episode of that one.
Is that Netflix?
Netflix.
Okay, I got to
Yeah.
check that.
Go
out.
check out the Arnold one too.
The Arnold one is.
Schwarzenegger.
Okay,
I was
we
going to say
were
that was
talking about
actually
that the other
Arnold
day.
is that Arnold one
Alright.
makes me wish that Arnold could run for president.
Really? I gotta steal one of y'all's Netflix passwords again.
Can't.
No,
you
can't
can't
do
do
it.
it anymore.
Yep.
I have to buy Netflix.
Yeah.
All right,
Yes.
something else is gonna have to go then.
Break
sorry,
down, dude.
Sorry,
Get
Disney
rid of
Plus.
Disney Plus.
I know.
They haven't released anything good, and you don't have kids, so you don't.
And
need
I
it right
don't
now.
watch Mandalorian either. I don't even know why I have that.
Yeah. All right. DeepBlueRE.com. Thank you guys. We'll see you next week.
Bye now.
Toodles.